Welcome back to Capital Conversations. I'm your host, AJ Smith, and today's guest is a total powerhouse. Michelle Goheen, she's the founder of Collegiate Capital, and she's a student housing syndicator who's turning heads across the country. I first met Michelle in a mastermind called M1, and she has been crushing it since she joined that mastermind and just doing her own stuff by herself as well. So Michelle has spent about 30 years in corporate finance, PwC, EY, billion-dollar IPOs, and she traded it all to build her own real estate empire. She's now leading one of the hottest student housing projects in the United States in Oxford, Mississippi, of all places, where she's pre-leased 100% of her units before construction was even finished, with over 200 students on the waiting list. So if that's, it's that competitive, and she's winning. So really excited to have her on. Michelle brings elite level strategy, data-driven investing, and the kind of tax-efficient structures that make her deals just as smart as they are profitable. So Michelle, welcome to the show.
Hey, thanks, AJ. It's great to be here.
Yeah, glad to have you. You had a dream finance career, PwC, EY, you were doing some IPOs. What made you walk away and bet on student housing?
That's a really great question. And it sounds like what we were talking about. We've got pretty much three of the big four covered between Deloitte, EY, and PwC. So that's kind of fun. Go accountants. Well, it's kind of, it's interesting. It's what you do for your kids is what I'll tell you. Is my oldest is at Ole Miss, which is in Oxford, Mississippi. And when we first went to admitted students day, she was like, "Hey, Mom, you should buy a house here." And I was like, that sounds like a good idea. So we looked around, and I ended up buying a really great, it's like a brand new townhome duplex type thing. And I had such a good experience. I talked to the developer. I said, "Hey, where are you building your next project?" He literally took me to a field down the street and said, "Hey, this is going to be it." And you know how it goes, like we have FOMO, and you're like, "Oh my gosh, I've got to get one." And so no, I just didn't get one. I just got the whole six. I got this whole sixplex. And then realized, oh, dang, I spent a lot of money, and I've got a kid in college. And I was like, but, I've raised capital for other people my entire career. So let's put together a syndication and make this happen. So that's where it all started. And it's just been going great since then.
So tell us about that Oxford deal, the one that put Collegiate Capital on the map. How did you find it? What made you say this deal is the deal?
Well, again, it was really just going and seeing what was out there. I had done a ton of research at that point to realize that Oxford is a really, really hot market. You wouldn't think like Mississippi, but there's a couple of things that make Oxford very unique. One of which is the terrain. And again, you wouldn't think Mississippi's got like a lot of rolling hills, but it's very hilly, and there's a lot of water, like a lot of rivers and things that really make a lot of the development difficult. And it's also got a lot of history, a lot of historical areas that make it even more difficult to build right around the campus. So with that, and just the popularity of coming to school in the South, it's just been booming, and they have not been able to keep up with the demand. So they, as a university, went to 5 different apartment complexes and master leased 5 different apartment complexes to consist of student housing, on-campus housing. So if you sign up to live in the dorms, you may live in a dorm, or you might live in one of these 5 apartment complexes that are right around campus. Now, what that does is it just kind of trickles downstream, and everybody who's like a sophomore and junior or senior who's looking for an apartment now has 5 less apartment complexes to choose from. So it is really driving, they call it the Hunger Games in Oxford, because it's literally, I have everything. I know you said it was before, I had it all leased before it was finished. I actually had the whole thing leased before they actually even started the construction. So it's a great market. Lovely, lovely people. And it's, it's one of those things that the kids move in August, and by October 1st, they have to tell me if they're going to come back or not next year. And if they're not, we offer it up to the general population, and it's gone within, 12 hours. So
So let's talk more about that demand, right? Because you had a wait list, I think, of like 200 people deep.
Oh, probably more than that. Yeah.
Yeah. So like what's driving the demand in Oxford? I understand there's a huge amount of demand. Is it just students love to go to college in the South, like you mentioned? Is there something else that's in Oxford, Mississippi in particular that's driving that demand?
Yeah, Oxford is a great place. And it's one of those things, if you take your kid on a college tour to Oxford, pretty much just stop by the bookstore, buy all the merch, because that's where your kid's going to go. It's just the most amazing town. And Oxford was named the best small college town in America by USA Today last year. And so it's, that popularity, the popularity of SEC sports, Ole Miss is all over the place. With sports, and just the favorability the South has over, I guess that's not the really right way to say it. Like a lot of kids from the North want to come to school in the South for, it's a lot less expensive. It's a lot warmer. That have these schools with a lot of spirit. SEC sports is not like anywhere else in the country, and so that's really driving a lot of the population from the North and from, the California areas as well.
So the enrollment's up from the North, from these California areas, housing super tight. It sounds like you've got potentially more phases coming up. Do you think this is more of a temporary boom, or is it a long-term trend of these kids coming down?
That's a great question.
What's some of the data that you're looking at as well?
Oh, data. You know me, I love data. Well, I will tell you, if you look at the Ole Miss plan through 2030, is that they want their enrollment to be 30,000 kids as of 2030. They're at 24,000 and something right now. So that's almost 6,000 more kids in 5 years. And so they are slowly increasing the freshman classes as time goes on. So, 2022 was a record freshman class, 2023 was a record class, 2024 was, and they're going to have probably 600 more kids this following school year. So enrollment continues to increase. They are also, if you look at the plans for 2037 that were put out by the city of Oxford, there's a lot of the same problems. There's just a limited amount of land in Oxford or Lafayette County. You can go further out, but these are college kids. They don't want to drive another 10 minutes to get to school. Mine was like, I want to be as close as possible and not have to, sleep an extra 10 minutes. So that is really what's driving a lot of it, and just the newness of the properties that I'm developing, because they are all brand new construction. These do not look like where I went to college. I went to Baylor a long time ago, and these are brand new townhomes that are like 2,000 square feet, just stainless steel appliances, beautiful, beautiful places that the kids want to be here, and the parents want their kids to be there. So that's been very, very helpful in, just keeping us 100% occupied.
Yeah, I've seen the pictures. I'm just kind of chatting with you offline and on other instances. It's beautiful. They're very, very nice.
It is beautiful.
I'm curious. So the university itself has the goal to grow its student population pretty substantially. Why do you think it is that the university isn't building this housing and they're leaving it more up to private developers?
That's a great question. They are actually in the process of redeveloping one of the dorms. They actually tore it down last year, and they're replacing it with new housing. However, that just takes a lot of time. And so those dorms should be back up and running in 2026. Yeah, next school year. But then there's another dorm that they call Krusty Crosby, because it's really old. And apparently it hasn't changed since like I was in college. And so they are going to have to do an envelope where they actually enclose the building and do the renovations that way. They can't tear that one down because it's very tall, and they would not be able to replace it with the new housing or the new zoning laws there. So that's going to take another few years. That's going to be out, and that's almost 1,000 kids that are in that dorm. So that trend is going to continue. And I think they've just found that they would rather have private parties put together these deals for them and let them focus on what they do best, which is school and sports.
So Collegiate Capital is growing very fast. What would you say is your mission behind the brand, and what do you want your firm to be known for?
Wow, that is a great question. As a mom, one of the things that's been super fun for us is to really educate the kids that are living with us and other college-age kids. We have a vertically integrated property management company called, guess what, Collegiate Management. And so we started an adulting series that basically any kind of question that we get or issue that we get from our residents, we'll just put it into this adulting series and stick it out on Instagram and Facebook. And, we keep everybody private, so nobody knows really who did what. But we've really generated a lot of great content with that. But, I think we really want to be known for very high-end, well-managed, well-maintained student housing. And then we're also kind of branching out into, I kind of jokingly call it like non-student housing, where in these college towns, but there's a big demand to not be where the kids are for a lot of the, either the families or the donors or the coaches, or there's just a whole faction of interest right now with non-student housing. So we're working on a project right now in that genre as well.
And I know you have a pretty extensive background as a CPA, so I want to ask some questions on that front. You're not just buying cash flow or buildings, essentially. You're looking at tax efficiency, you're looking at the cash flow, you're looking at how do I maximize this thing? I'm really curious, can you walk me through how do you structure your deals, and can you kind of talk us through the investor setup behind the scenes?
Yeah, absolutely. In the syndications that I've done both syndications and then just brought in a single joint venture partner. But we'll talk about syndications. I use Syndication Pro as my portal and get everything set up with that. So I keep it really, really streamlined. I'm obviously the general partner, and I raise limited partner capital. And with that, we talk about tax efficiency. I'd like to be able to offer people really tax efficient ways to invest with us. So for example, if they have a 1031 looking to deploy 1031 funds, generally you can't do that into a syndication. You can't switch, real property for limited partner units. But what you can do is take your 1031 funds and invest them as a tenancy in common into the syndication, the entity, and you're able to do it that way. It's called a TIC. So we've been able to take on 1031 money that way, which makes it really fantastic for them because they're able to defer their gains into this now cash flowing entity. Similarly, I love to use self-directed IRAs. And that's something that a lot of people that I've talked to just aren't aware of, that they can take an old dormant 401k from like Deloitte, like when you're working at Deloitte, if you still had it sitting out there, you would be able to take that and just literally almost roll it over, per se. It's really easy, into a self-directed IRA, and then take that money and invest it in syndications. Isn't that fun?
It's so fun.
It's so fun.
It's so fun. I had a guy. I had Paul Erbs on the show.
Yes.
2 weeks back now, and we were talking about self-directed IRAs, and we were having a good time.
Yes, he's awesome. He does all of my self-directed IRAs.
Nice. Yeah. And there's so many different ways to invest in real estate in a tax deferred manner. I'd love to talk a little bit more though about syndication myths. I'd love to do some syndication myth busting. Can you just share with us like what are some of the most common myths that you found either before you started syndication that folks had in their head, or maybe you had in your head, that maybe you've dispelled as you've been educating people or as you've been going through the process yourself?
That's a great question. Let's see. The first thing, since we just mentioned self-directed IRAs, one of the things that people who've actually talked and heard about this process before and investing in syndications, they'll be like, "Ooh, I don't want to do that because there's this thing called UBIT that you get taxed on, and I don't want to pay tax in my IRA. I'm like, no, you don't want to do that. What that stands for is the unrelated business income tax. And if you're in a self-directed IRA, and I don't want to get too technical because I can nerd out on this really bad. Essentially, if you have a syndication or an entity that has debt on it, so let's say there was a $100,000 investment, and there's 30% equity and 70% debt. Under the UBIT calculation, you would have to determine your unrelated, and this gets really nerdy, your UDFI has to be calculated to figure out your UBIT. Like, I know that's a lot. So, but it's unrelated debt finance income is UDFI. And so that would be the income that you make related to the part of your investment that's leveraged. So that 70%, you would actually be taxed essentially on that as unrelated business income tax. Now, here's the myth busting part, is that with a self-directed IRA, you are going to have distributions. So as your syndication makes money, they're just going to send your IRA the distribution money. You'll never see it because that's part of it. In order to keep it tax deferred, they just send you the money. And then at the end of the year, they will send you a K-1. And if your syndication people are doing their job, they're going to have this maximized for tax efficiency. They'll have done their cost segregation. There's some other tax things that they're going to take with regard to mortgage interest and things like this. So they're going to maximize this to have the biggest loss on paper that they can. So while you're getting cash, cash flow, you're also going to get a huge something that says you've lost money, which is good. That's kind of scary. And so, but what this does is you're able to offset that K-1 loss with your income. And so it ends up negating the UBIT tax on self-directed IRAs. Isn't that cool?
It's so cool. And I think something that I've learned as someone who is educated in accounting as I was going through college, people always look at like real estate losses as like, oh my gosh, why would you own a business and aim to lose money? Well, that's not actually the case. It's not that you're losing money on a year-over-year basis. There's something called paper losses, and then there's actual losses. And paper losses, essentially, they allow you to deduct more according to your taxes. Based on different things. So depreciation, like you said, accelerated depreciation, various expenses that you have throughout the year. So it's really cool tax game and have tax professionals with you that are experienced in that as well.
Absolutely. And, it's kind of funny because it's almost like a game where you're like, the bigger the loss, the better. And real estate's probably the only thing you're like, yay, I got a bigger K-1 loss, but you really have cash flow. So it is fantastic. The IRS does like real estate investing, and they're really trying to encourage development.
100%. One question that's a detailed question, because you and I both love details. Yeah. The U in the UBIT and the UD, whatever it was. Unrelated to what? What does that mean?
Oh, that's a good question. Well, it would be unrelated to the way that you usually make money. So this is going to be unrelated to the equity interest in your 401k or your self-directed IRA. But that it's just unrelated business income tax. So unrelated to either with the UDFI, it's going to be unrelated to the equity, and then the UBIT is just unrelated. But that's a really good question. There's probably a whole bunch more definitions, but that's just how I've always associated it.
Yeah, I'm curious. I'm curious because like you were in the M&A space for a while, and you built a career on that, multi-billion-dollar M&As. Real estate's a pretty different beast from that, I would think. What are some skills that you would say transferred over perfectly, and maybe what didn't?
I think that is a great question too, because I would say the skills that you do in underwriting a deal have, just direct correlation with my M&A background. You're looking at what the cash flow is, how sustainable is it, what the expenses are, how sustainable are those, are there one-time event? There's all the things that you use in M&A called like a quality of earnings. Something like that is very similar to what real estate does when you are going through the underwriting process. Something that really matches up really, really well. Now, I will tell you one thing that does not come over and it is the way that you present a opportunity. For example, when I first started raising capital, I had put together a pitch deck that I thought was great. EY would have been like thumbs up. But you know what? I scared everybody because I had a lot of numbers and a lot of data, and a lot of big words, and that's not how you sell syndications. So where we met in our mastermind, I really got hammered at the beginning because they're like, Michelle, you cannot do this. You have to really simplify. You need to sell yourself, then your team, and then your problem and your deal. And don't throw all these numbers out there. Put those in the data room. And if people are interested, they'll go look. And I still didn't believe them. I'm like, you guys, that just is weird to me. Let me just put them as an exhibit. And they're like, no, don't do that. You need to put them in the data room. And so I finally acquiesced and said, okay, I'll put them in the data room. And you know what? Guess how many people on the first syndication actually went to my data room? I actually had one. I had one.
One. That's surprising.
Well, and I had spent so much time over, really making it great in one person. So that was a huge, a huge lesson that I learned because I spent so many months, slaving over my pitch deck, thinking that I needed all these statistics and data and numbers that I really didn't.
Yeah, that's something I got hammered on too. And
okay, good. I feel better.
Yeah. I mean, we both come from pretty similar backgrounds in terms of work experience, kind of accounting backgrounds, and so we're so focused on the numbers, we just assume everyone else is, but that's really not the case.
That's not.
Yeah,
it's not. And really, the more I think it gets complicated, and you use big phrases and big terms, and I think people just get intimidated and think, oh, this is way too complicated for me, and then just are not interested. So I'll have to send you a link. I wrote a book about syndications, and it really goes in and describes what all of these things mean. What's a GP? What's an LP? What's IRR, what's return of capital, all of these. And I really just wrote it just to be able to explain to my potential investors who had been in real estate before, but didn't realize kind of the power of syndications and how you can invest in real estate, but I always joke, but you don't have to be in real estate. So you're not taking those calls at 10 o'clock on Friday night when somebody gets locked out of their house because they didn't realize that beeping noise was the battery on their keypad going out. They're like, it's been beeping for weeks. That actually made it into the adulting series. But as a limited partner investor, you don't deal with any of that. I get those. No, I don't get those calls. But as a general partner, that's my responsibility, not yours.
So let's talk about that because you're based in Texas.
Yes.
You're investing in Mississippi. How do you manage development and operations remotely, and how do you make sure that quality stays high?
That's a great question. On the development side, what I've been doing is buying units. It's all been new construction, but buying from the developer at a set price. So I do not have a construction background, and I don't, as a blonde mom from Texas and Mississippi, I don't want to be out there overseeing the construction every day. I don't. I'm going to really rely on the experts to do that. So I go in with a fixed dollar amount that I'm buying something for, and they just get it done, which I love. I do have, I'm in Oxford quite a bit. I have in that duplex that we talked about, I've got a room, and then my college upstairs. My daughter and her roommate live upstairs. They kind of jokingly call it co-colleging because I'm kind of hanging out with the kids, but they are going to be moving somewhere else because I'll end up being in Oxford a lot more over the next, the next few years. But what I do, I have a couple of different things. I've got some people, boots on the ground, I like to call them, that are real estate and accounting majors that help me manage a lot of the day-to-day. And they just do a fantastic job. If somebody wants a tour, we've got some units that we can tour to see, because obviously they're under construction. They want to see what they look like, or handle just anything that they need. And I've got a team of a great repair and maintenance people. So that makes it very helpful as well. And I've got two other assistants that are not in Oxford, but are just fantastic at helping with the leasing and, all of the things that are involved in syndication, the investor relations, all the emails, all the social media, you do it all. So there's a lot to it behind the scenes.
Yeah, that is genius. Using the real estate majors at the college and the finance majors and just having them give people tours. You know that they're bright-eyed and bushy-tailed. They're already there. They're going to give a good impression. That is so smart. I love that.
They are. Well, and you know what? They are so particular as well. And they'll be like, these people are great. Or, they'll indicate maybe, they have like 100-pound dog they brought in. The thing was like, tearing up the grass and super destructive. So that kind of gives us some things to like look out for when they process their application. Things that are just good to know when you have actually like, eyes on people.
Right. And now that you've proven out demand, that demand's proven itself. Phase 3, phase 4 of the Oxford build out. What's next? What are you doing differently now that you've already seen the first couple phases?
Yeah, so we have phase 1 that was up and running last year. It's been great because it's been outperforming our pro forma. I don't know if I mentioned, I have a phase 2 that's under construction right now. That was the one that was literally 100% occupied before Thanksgiving last year. And that construction will be done in July. I've got all the capital raised for that. It's going really, really well. So I was introduced to another developer who is developing, it's kind of a mixed use building. It has residential and some commercial. So it'll be a nice coffee house and either a day spa or a gym. They're still kind of deciding how they want the other side to go. But it's 22 bedroom units that are a little bit higher end finish out that overlook the airport at Ole Miss, which is just the coolest location. There's a little golf cart path. So people literally that fly in, and there are a lot of people that fly in to Oxford, they can get off their plane, hop on their golf cart, and just literally 2 minutes be at their new place. So this, I think, is going to end up being a non-student housing building. And we're really kind of, the same market, but we're kind of attracting the parents and the coaches and the people that, that pay the bills, essentially. And we'll be offering, furnished options and concierge services. And again, I'm going to use the hospitality students to really help us manage that piece of it, where, the people who are leasing from us will say, hey, I'm coming in, I'd want, here's all my favorite snacks, my beverages I want. It's my wife's anniversary. Could you pick up a present? Could you, have some flowers, whatever they need. They can literally sit and have their cocktail on their balcony overlooking the airport. Like, I want that life.
100%. Yeah. And you mentioned the parents and you mentioned the coaches. Really curious, what kind of investor would you say is like perfect for your deals? Who do you love working with for these projects?
I love all my investors. It's actually been fantastic. I would say it's probably kind of one of two things. I love working with people who are just professionals or people who have saved money and interested in investing in real estate and may not know how. My minimums are generally about $100,000 to buy into limited partner units. So I love helping people figure out, should I use my self-directed IRA? Should I just use this or use that? Love that. And so I have people who are dermatologists. I've got some CPA firm partners. I've got lots of those. I think CPA firm partners get it. I've got people who are in business or in sales. I have two musicians in California that actually write the music that's behind commercials, which is really fun. So, those types of people that are, interested in just making more from their money. They kind of, like I was like just seeing my fidelity returns, like, they were okay, but now with real estate, it's going to be much better. And then the other type of investor I have are people who have an appreciated property and want to do a 1031. Because what I'm able to do is either joint venture with them and take in the 1031 funds that way, or if they, say they have, let's just use $1 million because it makes it easy math. They have $1 million of a 1031 that they need to reinvest. They can, one, just joint venture with us and we can put it into a deal. Or if they want to buy, let's say, an $800,000 replacement property and have $200,000 remaining, we can show them how to invest in syndications with that 1031 money. So I love being able to do that, because the thing that makes them super excited is they're like, wow, I can do this and I don't have to manage this property. Because if they're selling investment property, they've been most likely managing it to some degree. So to come into a syndication and not have to manage it, they get really excited about that.
And when you have a strong operator, syndications can be a really solid move. Let's talk about risks, right? What's your playbook for downside protection when you're working in a niche like student housing?
Okay, I think that's a great question. I would say my risk going into it is just, I have everything leased right now, as people are going to be moving in August 1st. I do have that construction risk. So it is important that we keep in touch with the developers. They've never, knock on wood, they've never missed a delivery date. So we just, have to make sure that things are going to be done, because otherwise I'm going to have a whole bunch of upset kids and even more upset moms and dads coming at me. So we got to make sure that happens, because there's nowhere else to go in Oxford. Literally, you miss your deadline. I literally tell the developers, these kids are coming to your house to stay until your house is done, or until their house is done. So I would say the other, people kind of think, oh, student housing, is it like Animal House? Remember that movie? Like, it's really not. Like, some of the moms call and go, oh, could you tell me what the dimensions of their closet is? Because I'd like to be able to have a rug with an ottoman in their closet. Like, that's not really Animal House. So that part's really been debunked. Of course, we have a few, that are loud or like to leave things on the patio that they probably shouldn't, out in plain view. Like, don't want to see that. But I would say what we do from an insurance perspective is very good. If things go wrong, the first $150 our leases are covered by the student. So if they need filters, if they need light bulbs, if they have a small repair, that's going to be on them. So we don't get nickeled on dime like that. The next thing is if they really screw up the place, we do have generally a little bit more than 1 month's rent as a security deposit. Mine are primarily 3 bedrooms, so that's almost $5,000 that we have if things go bad. We also have ACH forms on file and personal signed guarantees from all the parents. So it says, I guarantee to pay everything under my sweet little honey's lease, and here's my bank account. So I really like that as a risk mitigator. So if anything goes wrong, we have the access to be able to do that. So far, so good. Again, knock on wood. And then the other thing is we do have business interruption insurance. So if for some reason somebody burns down the building, they have $1,000,000 of liability insurance. And then we have insurance on it as well as replacement of rents. So if it's not able to be rented, we are still being paid rent from the insurance company. So
there's nothing like having mom and dad's credit card on file to actually deadline.
No kidding. And they will every once in a while get fined by the HOA for leaving their trash on the porch or things like that. And when I say they get fined, it's like it literally comes to us because my name's on the bill to Michelle, and then we'll have to bill them for it. And my leasing manager will just send a note and say, hey, we're going to bill you whatever on whatever date. And we just make that happen. So it's much simpler to have that signed personal guarantee and the ACH versus having to go out and get it. And the other thing is we use those ACHs for the monthly rent. So I literally, like today was the first, all of our rent hit, we're done. We don't have to go chase somebody and hope that they, didn't spend it all on the betting on, I don't even know what sports are going on right now. They didn't go, pizza and drink beer and spend all their rent money because we already have it.
So what would you say is the biggest challenge you've faced in this business so far? And what did it teach you?
I would say that's a really good question. The biggest challenge for me was my initial attempt at raising capital, because I thought, been there, done that. I've worked in M&A, IPOs. I've raised tons of money. But I didn't realize when you're raising these smaller amounts, it's not that easy. I mean, they joke, and the M1 guys, it was like M1 says for the first million is the hardest. And that was true. That was really difficult as you're trying to prove your thesis and what you're doing. You don't have a track per se that they can, go look at. That was hard. And of course, I was trying to sell it the whole EY way, which made it even more complicated. So I think that was probably the biggest obstacle that I ran across. But for me, it was getting together with people like you in masterminds and really learning from people who've been there and done that was huge. And listening to them. Don't, try to recreate the wheel like I was initially with my pitch decks. Listen to them because they know they've been there and done it and they know it works.
Yeah, one of the things that helped me a ton, I remember watching someone in the mastermind, they had this presentation. I was like, oh my gosh, that was amazing. Like the design was beautiful. The way that he spoke was eloquent and easy to understand. And so I just jotted down a ton of notes and I took screenshots of his slides. And I was like, I'm using these.
Were you like taking pictures during his Zoom? Yes,
100%.
Yeah, exactly.
So let's talk about the concept of legacy, right? I mean, what you're doing right now, you're buying new construction townhomes in a booming market. You could hold on to these for a long time. How do you think about legacy right now? Are you building for generational wealth? Are you building for impact? Both? What does that look like?
Oh my gosh. You know what? I really don't like the phrase generational wealth when we're talking about what I'm doing, because most of my people who are, thinking generational wealth are investing like $100,000 or $200,000. That on their own is not going to make them generationally wealthy. And so I don't want to I'm going to create generational wealth for you, because you know what? If you keep investing with me and you keep going, yeah, maybe we can, but I don't want them to think that they're just going to retire and, have generational wealth after their one syndication. But the way that we have things structured right now is that we'll do some type of return of capital in, let's say the beginning of year 4, and then do some type of exit in year 5. Now, I would want to be able to 1031 out of that so we can roll into something else. And, it will appreciate, according to our projections, they put the asterisk in there, with all the disclaimers, and that we'll be able to invest in something else. So we will just be able to be very opportunistic. And what's really cool is the way that we are buying these. It gives us a little flexibility because they are condos, but they're in a block and they're in a neighborhood that someone would come in and buy them probably as a portfolio. But, if we were able to make more money and have them buy them, just a building of them, that would work too. Or if the market got where it just made sense to buy them one and sell them off one at a time, we can do that too. So I love the flexibility that this strategy gives on the exit, for sure.
And a lot of people want to raise capital. Like you mentioned, sometimes they have a hard time doing it. They may not know how to inspire confidence with investors. What do you think builds trust with investors the fastest?
Wow, that's a really good question. I think first impressions are important. Being a CPA and having the background that we have, I think really helps, because we are able to talk to how we've underwritten it, how it's under, these types of assumptions, and our assumptions make sense and our Excel works. That's really always a very important. But then to kind of been there, done that on much bigger deals. I can tell you, when we worked with, the firm KR, which is one of the biggest private equity firms in the world, these deals that we did, and how we were able to take the things we learned there to apply it to here. I think that really speaks a lot to trust and to, being able to get that confidence that we could execute. And I think also being able to talk on the tax strategy side, I think that does help as well. So yeah, it was funny. I had a meeting at lunch today, and we were talking about the whole self-directed IRA thing. I know we had talked about that before, and I said, "Oh, I'm going to talk on a podcast about that this afternoon." And I said, would you like me to send you some more information about it? He goes, "Oh, no. If you're on a podcast, you know what you're talking about." So, I think things like that really help kind of build trust. So hopefully I'm not totally embarrassing myself, but
It's honestly really, really cool sometimes to hear the stories about how folks watch podcast episodes or reels and they get a whole catalog of information from this person's brain, and they get to hear their experiences and see their stories and get to know them a little bit. And that does build a great amount of trust. So I think that's super cool. But another question I had was, what do most new investors, we were talking about like generational wealth before, right?
Yes.
And that whole concept and like investing in one syndication, now you're generationally wealthy, not being the case. What do you think most new investors misunderstand about passive investing in real estate?
I would say the biggest thing that they probably misunderstand, and one of the things that I am sure to always describe, is when they talk about, oh, I'm going to get an 8% preferred return. I think a lot of people think they see 8% and they think it's like interest in the bank. They're like, oh, I'm just going to have 8% a year. And that's how that's going to work. But as you and I know, that's not how it works. And so making sure people understand that, and that it's distributable cash flow, as you can. And then the general partner essentially won't make any money until these limited partners make whatever their 8% or whatever their percentage is. So trying to make sure that they understand that and they don't expect their 8% check the first quarter, as things are ramping up.
Right. Yeah. Understanding the capital stack and understanding how that actually works, I would 100% agree. I think there's definitely a lot of misunderstanding when it comes to preferred return. Is it guaranteed? Is it not guaranteed? When do I get it? All that kind of stuff. So I think that's something that's definitely necessary to expand on when investors are looking at projects. Like, okay, is this accrued? Is it compounding based on any preferred returns that are deferred? All those questions should be answered before someone invests in the syndication.
Absolutely. And then also, when does your preferred return start accruing? Is it when I send you my money, or is it when the project and the money is deployed? Those are two different things that you'll see based on different things. So like my people, they start accruing when I get the money. Some others are when it's deployed. So make sure if you are a limited partner investor that you're asking that question for sure. And I would say, oh, go ahead. I was going to say, the other question that I get is like, they get this K1 and they're like, oh my gosh, we lost all this money. And so I think understanding like that's good. I'm like, oh, that's a good thing. Having people understand the difference between a tax loss or a paper loss and actual cash flow or distributions and how those relate, and why getting a minus sign in front of your K1 is a good thing.
Yeah, huge difference. And that's one of the biggest, I think, misconceptions in real estate overall is real estate's one of the most tax advantaged asset classes out there. And like you said, it's because the government wants to incentivize real estate investments. And so they give you a lot of ways to reduce your taxes through real estate. So that minus sign on your K1 is a good thing, because you're doing essentially what the government wants you to do, and they're giving you a tax break for that. Yes.
Now, I will say the one thing that I guess a lot of people probably don't realize, though, is that the minus sign in the loss, depending on how you're taxed, how you're classified and things like that, you may not be able to take that whole loss your first year. So if it's a true passive investment and you have a W-2 income and that's all you have, and maybe you have like a rent house with some rent coming in that's passive, you can take that loss to the amount of the income that you have. And then I think there's a $3,000 on top of that. And if you can't use it, that's okay, because you can roll it forward until you can use it. So even though you don't get the full benefit of it the first year, essentially when you actually have an exit, assuming that everything goes right, you should have a big gain at the end that you can offset that loss with. So you're also being able to generate this appreciation. I don't want to say tax-free, but some of it's going to be, offset with tax losses. So that's also good.
Right. So for someone who's stuck in, let's say, a high income, high tax W-2 job, what's your message to that person about real estate?
Wow. Okay. Because I don't think we've really talked about, I also have a small real estate tax strategy company, and we talk about this a lot in there. And that is, I would say probably two things. If you have a W-2 job, now this isn't everybody, just if you have a W-2 job, I think it makes the most sense if, and this is a big if because it requires a lot of work, if you actively would manage a short-term rental, because that would allow you to do the short-term rental loophole is what they call it. And you can offset your loss against your W-2 income. That's really, really cool. And so that's the best thing for a 1099 person with their cash. Now, a W-2 person with their cash. What I would then tell them is look at what you have in your IRA, your 401k, 3 jobs ago when you were at Deloitte and you've like kind of left that money over there. Let's talk about how you can best use that. And I would say, look at considering real estate syndications and call someone like Paul or call us that can refer you to the Pauls of the world that can self-direct the IRA for you, because it's not something you can't self-direct it by yourself. You're required to have a self-directed company do it for you. So that would be my other thing. So to really maximize your benefits that you're receiving from your retirement funds.
And it's not just a requirement either. I mean, there's so many things to understand about self-directing your funds that having someone who's an expert that will know, I wouldn't call them loopholes, but the obstacles and the hurdles that you may need to overcome, or some of the different requirements that you may need to hit, it's huge. It's so helpful to have them on your side. And I think having an expert like someone like a self-directed IRA custodian is incredibly helpful and super important. So
absolutely.
So what's a deal that you passed on that maybe still haunts you, or one that you almost skipped but turned out great? That it could either be maybe in like the M&A world as a general sense, or maybe as you've been looking at other student housing options, or maybe some projects in the past as you've started your real estate journey.
Yeah, wow. The thing that haunts me the most is that I wish I knew what I know now back when I was your age. Like starting this like years ago is the biggest thing that haunts me. I had to wait till my daughter was going to college before I realized the power of syndications and being able to generate income and tax benefits and appreciation, not only for myself, but for other people as well, and showing them how to do this. Because most people think that the only way they can be in real estate is, getting a rent house and, spending Saturdays at Home Depot. And, that's not the case. And, I feel like I've really been doing a lot of education on, like I said, what are syndications and how people can best utilize them. So that's my main regret, is like not doing this earlier. Like Oxford 5 or 10 years ago, 20 years ago, dang, that would have been great. But it's still it's still a great market. And as I get more momentum, I'm focused on Oxford right now, but there are several other markets that are really fantastic as well. So, they say, what's the saying about you have to nail it to scale it? And so we're in the nailing it phase and are really to a point that we'll probably start scaling into other markets relatively soon.
Oh my gosh, that's so true. Nail it to scale it.
I love that. I know, I do too. It's so great. Yeah.
So what's a habit or a mindset or a tool that you rely on every day to stay sharp in this business?
Oh gosh, I am the biggest Peloton addict. Peloton bike. I get up and I ride my Peloton basically every day. Being able to just start the day with some fun, loud music and a good sweat is just important. Just put your mindset right. And really having a good, just a good group of people that you work with is so important. It's gotten to the point in my career that I don't want to work with people that aren't nice. This is going to be fun, and being able to work with your people is so important. So those are my main things I would say that I do every day.
I'm rereading the book Traction, and I was reminded as I was reading that book, right people, right seats. And right people is always a matter of like fit, right? Kind of cultural fit. Is this the person that has the willingness to do this thing? Do they get how to do it? And do they have the capacity to do it? And then the right seat, we want to make sure that they're doing the thing that they're the best at.
And are they nice about it? Are they going to be fun to deal with? Are they going to just make your life difficult? I spent plenty of years that I dealt with that, and it's just so great to not. So that's huge, to find your people.
So last question here. What's next for Michelle Goheen, for Collegiate Capital? Any bold moves or big bets coming up?
I just signed this airport deal a few weeks ago. So that one's really, really, really exciting. We are looking to do some more deals like that and really replicate that model. So I think that's really, really huge, to really focus on the student housing, but then also I need a better word for it. You'll have to help me come up with something that's like the non-student housing, the co-colleging people that are hanging out in these great towns, but want to be kind of away from the kids. So, really being able to take that model and use it in other markets that makes sense. But, it's just been great. And there's so many great markets out there. And it's just really finding, where do I want to be next?
And if people want to find out where you want to be next, if they want to reach out, contact you, where can they find you? How should they reach out? What should next steps be for someone who's like, dang, Michelle Goheen, Capital Conversations, I love that interview.
Oh, thank you.
Yeah. How do they reach out to you?
I would say the easiest way to reach me is probably on LinkedIn. Michelle Goheen, just right here. Easy to spell. I mean, I'm like there's only a few of me, so it's pretty easy. They can go to our website, which is collegiate-capital.com. And the guys at M1 were like, that's the worst website because it's really hard to spell. But unfortunately, it is what it is. If you want to learn some adulting tips, follow Collegiate Management Oxford on Instagram or Facebook. We're just kind of building our...
Awesome. Well, Michelle, great to have you on. Thanks for coming on. It's been Capital Conversations, and I will see you all next week. Take care, Michelle.
Thanks, AJ. You too. Okay.